The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for financial, legal, or tax advice. To determine which strategies or investments may be appropriate for you, consult qualified professionals prior to making decisions. Hey there, community bankers. Welcome back to the Correspondent podcast. I'm your host, Madison Kafflinger, Marketing Associate for ICBB, and this episode marks our first quarterly market update where we're going to discuss trends, current events, and other issues that have arisen for community banks over the past quarter. I'm joined today by our Chief Credit Officer, Stephanie Other, our Senior Lender, Brandon Feltner, and the President of our affiliate, Sapphire Fiduciary Advisors, Paul Stropke. How are you all doing today?
Great.
Doing well. Thanks, Madison.
Thank you. So if each of you could just take a moment to introduce yourselves to our audience, let us know a little bit about what you do and your expertise.
Hey, my name is Stephanie Other. I'm the Chief Credit Officer at Independent Correspondent Bankers Bank. I've been with the bank for 15 years, and my responsibilities include pretty much every department that a retail bank would have for the loans. We do loan administration, loan operations, credit analysis, and then Brandon helps out with the lending function. Like I said, I've been here for 15 years and the bank has grown tremendously over that time. We are in a different place different place today than we were 15 years ago.
My name is Brandon Feltner. I'm the Senior Loan Officer here at Independent Correspondent Bankers Bank. And I've been with Bankers Bank since 2020. And prior to joining correspondent banking, I actually worked in community banking as a commercial lender and was originating loans in that community. And now as part of correspondent banking, given our footprint, I get to help community banks all across Kentucky, Tennessee, West Virginia, Ohio, and Indiana, and Illinois with their participation loans. And also we originate officer director loans and their affiliates and holding company loans.
And I'm Paul Stropke, President of Sapphire Fiduciary Advisors, as Madison said, and I'm also a director of a community bank in South Central Kentucky and the bank holding company for it. I've been in the investment management world for many years, pushing 30 already in financial institutions. At Sapphire, we manage on a discretionary basis as a fiduciary for families and institutions. So we're portfolio managers. We do manager search, due diligence, and monitoring of mutual funds and separately managed account strategies as well as mutual funds. And we select individual securities and on the fixed income side and equities as well. So Sapphire became an affiliate of ICBI, the holding company for Bankers Bank, almost exactly 1 year ago. And we have marketed ourselves through Bankers Bank to community banks that don't offer wealth management services to its own customer base.
Yeah, awesome. Has it really been a year since we brought you guys on?
Yeah, right. The anniversary is actually the 22nd of April where we did the transaction. So ICBI is our equity partner as well as the S Corps that are owned by our employees.
Well, happy anniversary.
Well, thank you.
All right, so let's dive into talking about our community banks and the market. Let's talk a little bit about the state of community banks based on what you guys are seeing. So just offer some thoughts, if you would. How does deposit growth look for community banks? Is it up? Is it down? And, why do you think that might be?
I feel like it depends on the market, that if it's a metropolitan market or if it's a rural market, obviously with PPP and a lot of the money that was in the market, last year, it's been worked through the system now. So there's not as many deposits being held by banks currently. And some of the more metropolitan markets, but you get out to a rural market, they've got more liquidity, more cash to still lend. So it's a unique time. And it's really just different per area from what I've seen.
Paul, Stephanie, is that what you guys are seeing as well?
I'd say from our perspective, in looking at publicly traded companies, certainly there have been some high-profile runs on banks on each of the coasts of the United States. In the community banking area, I've seen some excess deposits run off. And so they have either gone to money market accounts through other providers, U.S. Treasuries, or frankly, with inflation that's picked up, to Walmart and to Kroger and to just daily living expenses. So, in terms of deposit growth, it's becoming more competitive, certainly, with the interest rate environment the way it is. The short end of the yield curve, the Treasury yield curve, is yielding much more than typical CDs have at community banks. And so, in order to compete for deposits, banks have begun to raise their CD rates, sometimes with specials and sometimes across the board.
Yeah.
The Bankers Bank has also offered CD special rates to get some more deposits in the bank. And like Paul said, that's one way to bring in cash, is to offer those higher rates on more long-term money.
Right. Yeah, I know we're seeing, some liquidity struggles among our banks, and so how has that affected loan growth?
Well,
Oh,
we're the Bankers Bank is a little bit different because our customer base is banks, and they're spread out over Illinois, Indiana, Ohio, Kentucky, West Virginia, and Tennessee. So we see loans from all of those areas. We're not concentrated in one specific location. So our particular instance, we get those loans. We're getting plenty of opportunities. Our pipeline is healthy. We've not really seen a drop too much in the number of loans that stay in the pipeline. And we are seeing loans of larger dollar amounts as well. But for the regular community banks out there, depends on their market. If you're in Nashville, you're getting all the loans you want. But if you're in Eastern Kentucky or West Virginia, you're not seeing much loan growth at all. And that's where we come into play and offer participation loans. That's how they get to grow their own loan portfolios, is by buying loans from us.
yeah, I would add to that as well. I feel like we're seeing a lot of continued loan growth in the metropolitan areas and in the rural areas. Loan demand is still down, but again, like Stephanie said, it gives them opportunity for us to purchase those loans that they're going on in Nashville or Clarksville, and then be able to offer those out for sub participation to banks that are in the rural markets of West Virginia or Eastern Tennessee or Eastern Kentucky, to be able to get that good earning asset on their books.
On the consumer side, I think it's fair to say that residential mortgage lending has almost hit a wall. Refinancing business, at least in our markets, has dried up. The only loan volume we're seeing now, with the rates that are higher, call it 6% rather than 2, would be for people who are relocating and have to borrow money to buy a new house. So what the Fed has done to attempt to tame inflation, with a rate increase from essentially 0 to close to 5% over the last 2 years, is something we haven't seen before. Even when the Fed tried to quell the exuberance around the dot-com bubble in the late 90s, didn't raise rates as fast as it has this time around. So this will have a lagged effect, but certainly on the residential side, it's had an immediate effect. I'd say that 6 or 7% on a historical basis is not a particularly high rate for a 30-year loan for a mortgage, but relative to where rates have been in the last 2, 3, 4, 5 years, it's a shock to the system and has really slowed activity down.
So mergers and acquisitions are kind of a consistent looming threat, I think, for community banks, the possibility of having to go that route. Are we seeing rates of that going up or going down over the first quarter, or is that too short a time span to really tell?
I would say that for M&A activity at this time is relatively flat compared to perhaps where it's been the prior years. I feel like that we will see some more M&A activity as we work through this year. There's going to be some opportunities for some older banks smaller banks to get purchased by some of the larger banks, and unfortunately, it's inevitable. It's going to happen, but I feel like right now it's kind of flat. But once we get through this year and next year, we'll probably see that heat up again. And then I'm also hearing more de novo banks are are in discussions, getting back, getting started up and coming to the forefront again as far as being a new opportunity.
Right. So, as far as interest rates go, I know we've touched on that a little bit, but what's kind of the trend that, and maybe Paul, you can speak to this especially, but what's the trend you've seen over Q1 of 2023?
What's interesting about interest rates is that the yield curve has become inverted, meaning short-term interest rates for Treasury notes are materially higher than long-term interest rates that are available for Treasury bonds as compared to a year ago. So, for instance, a 3-year note, a 6-year note, uh, those things are yielding about 5%. A year ago, they're yielding less than 1%. And then when we go out to the 10-year bond, it's currently yielding about 3.5, and a year ago was about 2.8. So across the board, interest rates are higher than they were a year ago, but this yield curve inversion sometimes foretells a recession. It has had a history of a fair amount of false positives, but it has persisted this time. The Fed continues to increase the Fed funds rate, which has forced interest rates up on the short end of the curve. But it is curious that the market anticipates that the long-term rates will be materially lower than they are today.
Okay, interesting. So, Brandon, Stephanie, how are you seeing community banks and then their customers responding to, this trend in interest rates?
From what we're seeing, as far as what I guess my perspective would be, most of the community banks are pricing a prime variable, and then putting a floor at that, and then perhaps some more of a ceiling, or going off of the 5-year T bill and using a margin of 3 to 4% to price these loans.
Also, to add to what Brandon had to say, it is based on location. Wherever your competition is. I go back to Nashville all the time because in Nashville it's so competitive. Some of those banks are offering lower rates for loans, but then when they sell them to us or try to sell them to us, it's really hard to participate those out because our customer banks that sub-participate with us couldn't put a loan like that on their books. So we get, stuck with either not being able to sell the loan because of the rate or asking the lead bank to find another participant.
How can community banks kind of respond to that in a way that protects themselves and minimizes their risk on their end?
It's sort of a game they have to play. They could get higher rates on loans they don't have to participate out, that are under their threshold for legal lending limit purposes. And then they'll have to, get more of a market rate on those larger deals that they have to sub-participate or participate. And then, hope that they can win the deal because of either their own service to that customer is outshining other banks. Or if the customer is already a customer of theirs that they've serviced for a long time, hoping that they would stay loyal to the bank in order to keep them and be able to still participate the loan out at a higher rate.
I would agree with that, and
So,
also too, if the bank already has other full blown relationship with the customer with other loans, deposits, they can look at loan relationship pricing to maybe be able to get the ROE that they need on this new loan that may be at a lower rate compared to others, but they're able to get there because they have other loans that are performing better to help the community bank overall get the uh, ROE that they need on this particular deal, and it's still attractive to the customer given the rate.
yeah, so just to make sure I'm hearing you right, you're finding that community banks are sometimes having to accept a lower interest rate, a kind of below market value interest rate in order to get the loans in certain situations, because of kind of slowed loan demand.
And competition.
Yeah, yeah.
And I'd say the other side of that, and I'm speaking from the perspective of bank where I help in South Central Kentucky, um, the cost of deposits, that's a meaningful input. So what you're trying to do, of course, is maintain your spread or increase your spread between the rate you charge on the loans and what you have to pay for that money. So as banks have had deposits flow out to treasuries or bond mutual funds or what have you, or to Walmart or Kroger, uh, they've had to come up with new ways to come up with low cost deposits. And that's a strategy that takes some time in order to, garner non-interest checking accounts and so forth. A lot of time and commitment has to be applied, and people have to be dedicated to building that side of the business.
I'm glad you kind of brought back the inflation piece, mentioning Walmart and Kroger. I can definitely identify with that. I feel like they have half my money.
Hmm.
Um, I think inflation, if there was a word to describe 2022 financially, I think it would probably be inflation. But what's the kind of trend that you've seen in inflation over Q1? Is that stabilizing any? Is the inflation continuing? What's going on there?
Well, I'd say, and I have some data through the end of February. Not all the data is available for March, but it has begun to cool somewhat. I think the headline number was close to 9% just a few months ago in last year, and those have come down. Now, the figure that the Fed looks at is called the PCE deflator, and it's still twice as high as what the Fed targets. And the Fed continues to pound the table that its long-term goal is to have a 2% inflation. We're far from there, but inflation has started to cool a little bit. It's offset by a ton of pressure in the labor market, though. There's still, I think, two jobs available for every person who's seeking, and this has put some pressure on wages, particularly in the service sector.
So I think we're all breathing a sigh of relief, I'm sure, to know that inflation is beginning to cool. But I know that, the kind of wage pressure, particularly in the service sector, is definitely something our community banks have to take into account. So how are you seeing community banks and their customers responding to um, this inflation that's still a bit high, but starting to cool? Is it cooling enough to where the community banks feel like some of the pressure's off, or is it still kind of presenting them with some challenges?
Think with given the current environment that we're in, is with inflation, liquidity is there's less money available in the market, and community banks and local customers, are paying more for goods, and the community banks are seeing that because they're not keeping as much. Deposit customers aren't keeping as much on deposit as they normally would. So it's definitely a unique environment that we're in.
So I think as far as current event goes, the big thing that everyone's kind of been talking about over Q1 is the major bank failures of Silicon Valley and Signature Bank, which, correct me if I'm wrong, these are major banks with correspondent divisions. Is that right?
Yeah, they're major banks. As far as correspondent vision, I'm not 100% for sure, but obviously they're large banks, and we're well looked upon as an organization until obviously this happened recently and the outcome.
I'd say the issue that Silicon Valley Bank has had that as I understand it, is uh, they had some sophisticated depositors with large balances, and they invested proceeds from those deposits in some long dated bonds when yields are very low. And so when the prevailing interest rates increased, mark to market on those bonds decreased. Interest rates and bond prices have an inverse relationship. And that's okay insofar as they don't need to sell those bonds. So they were categorized on their books as held to maturity. But Silicon Valley Bank suggested that it needed to raise a little bit of equity capital, which was a red flag to the market. And someone raised that as an issue on Twitter, and it went viral very quickly. So these sophisticated depositors began to withdraw from their accounts, and Silicon Valley Bank had to liquidate some of those securities and put them unavailable for sale and mark them to market. And that had a very rapid deleterious effect on their financial condition. And so it led to their demise over a very short period of time.
Yeah, I think I'd read recently they had 80 billion in bonds with an average yield of like 1.5%, which obviously was much lower than the current market yield at that time of over 5%, which obviously banks up the losses from selling its assets at a significant loss. I think another thing too that really impacted them is I think majority of their deposits were startup companies, upwards of like 65,000 accounts.
Based on the kind of culmination of all of these trends and all of these things, now we're well into the second quarter, but as we head into second quarter and rest of the year, what's one thing that you would advise community banks on right now?
I'd say from the perspective of the bank where I serve in South Central Kentucky, that really discipline is the best thing that we can have on the credit quality side, on the exposure to industry sectors and concentrations, and also on the cost of deposits. So to the extent that we can accumulate non-interest bearing deposits and have some discipline about repricing CDs as they mature, that'll be the secret sauce.
I echo Paul exactly. Your underwriting standards, keep underwriting well and looking at, speculative things. How are those going to come to fruition based on the current economic outlook? And then pricing the loans versus pricing your deposits.
I think that's good advice moving forward. Well, thank you guys so much for joining us today. I know our community banks are going to get some value out of this conversation, and hopefully there's something that they can take with them into Q2 and even Q3 of this year. I think if you've made it through 2022 and the first of this year, you've really accomplished something, and hopefully they can, carry that with them.
Well, thanks for having us.
Yes, thanks for having us, Madison, for being on here.
Thank you, Madison.
Thank
Have a
you,
good day.
Thank you. You too. Thank you guys so much for listening, and I hope you've gotten some value from this conversation to take back to your community bank. Make sure to follow or subscribe to The Correspondent wherever you get your podcasts and turn on notifications so you never miss a new episode. See you next time.